Welcome. Today is Thursday, November 10th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. Daily Five is that program where we take a look at those five charts that really have us interested. First, let me just bring your attention to a quick shameless commercial. We're going to keep this brief. Everybody knows I have a free newsletter. I just want to make sure that if you're not already on it, you can subscribe for free. Go to my website, jwhinvestment.com. On the menu bar, there's a little thing that says free newsletter. Click it. That'll take you to the newsletter. Scroll down, do what you have to do, and you'll find the most recent issue, which was published on November 5th. We've gotten a lot of really positive feedback on this. It's entitled The Three-Ring Circus, and I think you'll find it interesting. There's also a member level. I won't spend a lot of time on this, but we get a lot of comments from people. Hey, we really love your big picture views and huge insights, but how do we put this to work? And so, we've got this optional member level for $10 a month where you can get our top actionable trade idea every week. We email it out to members on Wednesday afternoon between 12 noon and 1 p.m. Central Time. So that is that. With those comments, let's jump right into chart number one. Last time we were on the show, it was, I believe, right around October 25th, maybe a day or two after. But, we made this comment regarding Montgomery cycles, and there were two major Montgomery cycle turn dates that we were kind of, focused on, discussing the potential significance of these. The first was October 25th, and the second was November 8th, Election Day. And just to kind of frame this, recall that Paul McCray Montgomery was, a really incredibly insightful and talented market timer whose storied career extended over 4 decades. And he developed some of the most innovative market timing barometers that we're still used today, including the magazine indicator. In fact, most recently, I think it was Fortune had Sam Bankman-Fried on it, and that might have been 2 or 3 weeks ago. And sure enough, his company looks like it's going to go bankrupt. They're upside down to the tune of $6 billion, and FTX, the cryptocurrency exchange, is the headline news on every financial media channel on television. So with that, these are still very, very good barometers. And his cycle work, which was based on a lunar cycle and a Fibonacci time scale, actually predicted that we would see a market turn on October 25th. And just to kind of review that, as of yesterday, the NASDAQ 100 topped on October 25th. That's the recovery high off of its October 13th low, and it is yet to be challenged. The S&P 500 has pressed above its October 28th closing high, but these are based on closing prices. So we'll have to wait to see how the market closes tonight to see whether or not this is good. But, basically October 25th plus 3 days. Paul basically said plus or minus 3 days to each one of these. So we're in that realm. And then the other date that he put out there was November 8th. And November 8th, of course, we saw the Dow put in its high on an intraday and closing basis. Today, we've gone through that intraday. We'll see how we close. But if we were to close at a new high today, it would still be within the window, plus or minus 3 days. So, the point is, we do have some significance to these dates. And if they do work out, it would probably mark the recovery highs for what we think is a counter trend advance here. But the most important part of this chart is the green line that we've marked these competing highs with, right? And what it really says is this: the high in the S&P remains unconfirmed by the NASDAQ. The high in the Dow remains unconfirmed by the NASDAQ and the S&P 500 on a closing basis. This divergent behavior between major market indices is very characteristic of a bear market. So, that's all I really want to say about Montgomery cycles. We won't bring it up again. It doesn't sound like a lot of people took too kindly to the idea of lunar cycles, but they're out there. We don't spend a lot of time on it. We're aware of it, and when we see something significant, we like to bring it to the attention of our subscribers and followers, just so that they know, more information is better than less information in our view. Chart number 2. This is what we really want to talk about here. Is a volatility spike likely to occur going forward? The VIX just reached its most oversold condition of the past 5 years. Now, historically, when the VIX becomes this deeply oversold, it has been really a prelude to a volatility spike. And so, looking back over the past 3 years in this chart, we can see that each time the 6-day RSI oscillator has reversed from an oversold condition back into at least a neutral condition, the VIX has spiked over that subsequent 1 to 3 month period into the 30 to 40% range. Now, in our view, the current setup, which is now more extreme than at any point in the last 5 years, and certainly the last 3 years, needs to be taken into consideration here. We just made a new low in the VIX this morning, but I think that could really be the kiss goodbye. And, given this oversold condition and the recovery out of it, I think that we should all be on alert for a significant volatility spike that could potentially propel the VIX above the 40% line, which we have not seen print in nearly 2 years. So with that, let's jump to chart number 3. This is another indicator that supports that idea that the VIX may be at the precipice of a significant volatility surge. And, what we've seen here is another divergence between the VIX and the VVIX. Now, whereas the VIX measures the volatility of the stock market, the VVIX measures the volatility of the VIX itself. In the chart, we have the VIX in the top panel and the VVIX in the bottom panel. And, here we would just note that the VIX made a new lower low today, yet the VVIX has so far made a much higher low today. And so this divergence between the VIX and the VVIX, they often precede a trend change. When we see a negative divergence in the VVIX versus the VIX, it's usually to the downside. And when we see a positive divergence like we're witnessing right now, it's usually preceding a big surge in volatility. So, more often than not, when we get these sustained positive divergences by the VVIX, it has preceded a surge in volatility or an abrupt VIX spike. And so just given the setup that's evident in the preceding chart and currently the evidence we're seeing here so far, it would not at all surprise us to see an abrupt VIX spike in the days immediately ahead. Chart number 4. Brobdingnagian base in the VIX. Well, what is a Brobdingnagian base? Well, the word Brobdingnagian derives from Jonathan Swift's satirical novel, Gulliver's Travels, where the land of Brobdingnag was occupied by giants. And so technical analyst John Roque coined the term a Brobdingnagian base, which he used to describe a giant base. And so, the point of this chart is that the VIX has put in a giant base, if ever there was one, right? And yes, we are aware that the VIX is a mean reverting index. However, that does not preclude it from reaching, extremes that fall far outside the normal range. Good examples would be 2008 and 2020, where we saw a 80% and 65% closing spikes on a weekly closing basis in the VIX. They got much higher than that actually intraday. But, I think that it's possible that this base will resolve to the upside similarly to what we saw in 2008 and 2020. And, it's certainly possible that the VIX is poised for just such a move. So with that, let's take a look at what is going on in the stock market right now. Chart number 5 looks at, a view that we've presented several times in this format. And, it's our long-term Elliott wave count. We're showing on the left-hand side a 13-year monthly view. This looks back to the March 2009 lows and looks at the advance going into the January high as being cycle wave 5 of super cycle wave 3, which is a 90-year advance that began back off the 1932 lows. But let's just focus on this 13-year advance and consider the fact that we need to correct it. It is a high, we have broken down, and we believe that this initial decline of a little over 25% from peak to trough this far represents the early sort of subdivisions of cycle wave A, of an ABC supercycle correction that will correct this entire 90-year advance. We think it's going to take a significant amount of time, and price will have to compress substantially as well. And we've got a couple of ideas here. First of all, our preferred count is suggesting that, under this entire rubric, the June low counts best as primary wave 1 down of cycle wave A down, and that the counter trend advance that we saw into the August 16th high counts best as primary wave 2 up of cycle wave A down. So in this 3-year weekly view on the right-hand side, you can kind of see how we've set up from that August 16th high and came down in what we define as intermediate wave 1 down, and now counter trend wave 2 up. And so what we're setting up here based on our best count is that primary wave 3 is now subdividing at intermediate degree of trend, and we're probably at the precipice. In fact, if this Montgomery cycle window of October 25th through November 8th is correct, then we're probably at the precipice of a third wave decline. And that would be intermediate wave 3 down, of primary wave 3 down, of cycle wave A down. Now, once that is complete, we would be looking for the S&P 500 to be challenging levels that would approach S&P 2250 to terminate that cycle wave A decline. That level comes into line with 3 levels of support that we've been looking for. The 618% retracement of that entire 13-year decline off the 2009 low. Also, a previous 4th wave extreme falls in that same general vicinity, as well as the 200-month simple moving average. So those 3 areas of support we think will probably arrest the decline of cycle wave A and set up for a major counter trend advance, which will be cycle wave B to the upside. And we think that could happen. We could see the lows of cycle wave A sometime in the first quarter of next year, and cycle wave B could rally for 9 to 12 months before it's over. And when it does terminate, we would expect cycle wave C to carry the market to significant new lows. So it's a very bearish long-term outlook. The short-term outlook is equally bearish. We're looking for an immediate decline in the S&P to 2750 to 2400 to complete primary wave 3 down. We don't have a specific time horizon for that, but since we're looking for cycle wave A to bottom in the first quarter, sometime before that. So you may have noticed on the first chart, there were 2 additional lines added, and that indicates that there are 2 more Montgomery cycle dates, one on November 23rd and another on December 7th. We don't have any specific notion of what's going to occur on those dates, but we're aware that they're there. So, we want to kind of think about those as being important dates based on whatever the price action happens to be at that time. As it stands right now, we think that investors should prepare for the next leg down. With that, I just want to invite you to reach out if you're interested in further discussing this. You can find me on my website at jwhinvestment.com or on Twitter at alpha_insights. And as always, thanks very much for watching, and good luck trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.